Welcome and thank you for joining us today for the HHC Capital Corporation Semi-Annual Board Meeting. Today's meeting is officially called to order. Please note for the record that Matthew Siegler is here representing Dr. Katz. So on our agenda is first on our agenda is the adoption of the minutes for the HHC Capital Corporation meeting held on January 28th, 2021. Are there any questions, comments, or suggested changes? May I have a motion to adopt these minutes?
So move.
Second. Our Chair Pagan is here, but in a viewing capacity only since he is virtual. So we'll start with Matt Siegler representing Dr. Katz.
To approve the minutes?
Yes.
Aye.
Okay, thank you. Robert Nolan.
Approved.
Fenioski Peña-Mora.
Yes.
Sally Hernandez Pinheiro.
Yes.
Great, the minutes are adopted. Now I'll turn the agenda over to Linda DeHart of HHC's Finance Corporate Reimbursement Division to provide an update on Capital Corp activities.
Thank you. As a reminder, the Capital Corporation was as a reminder, the Capital Corporation was formed as part of the system's security structure for its bond issuances to receive our patient care funds in a lockbox that is held for coverage of debt service on the bonds before it is released to the system for our operating needs. So as such, the Capital Corporation itself has no business, but the board meets twice a year and we use these opportunities to provide an update on the system's debt program. So on the first page of the presentation, we have a snapshot of our outstanding bond portfolio. We currently have $513.5 million of bonds outstanding. Roughly 25%, or $129.3 million, are in tax-exempt variable rate bonds, the balance being in tax-exempt fixed-rate bonds. The variable bonds are supported by 2 letters of credit from TD Bank, which has roughly 75% of the variable amount, and JP Morgan Chase having the balance. The variable rate bonds mature in February of 2031. We recently were able to extend the JP Morgan LOC to the 2015, the DNC expire in 2031. The DNE, which are secured by JP Morgan's letter of credit, we were able to extend recently the letter of credit on those bonds to February of 2026, which matches the final maturity. So we will not need to seek another extension. With respect to those bonds, we were able to negotiate very good terms on the renewal, particularly considering the longer length of the agreement. The letter of credit for the TD Bank letter of credit expires in 2023, so we will be reaching out to them next year regarding extension options. We most recently, the reset rate as of July 7th was 0.2%, and we estimate that over the life of these variable rate bonds, we have saved $67.7 million compared to a comparable fixed rate issuance. The next page provides some more detail on those historical rates on the variable rate debt. The top line there represents the spread against SIFMA, which is an index that is used in rate setting for tax-exempt bonds and sort of can be viewed as a measure of the competitiveness of the rates that we're receiving. The bottom line on the graph is the actual rate that we're paying. So it reflects, you'll see 2 spikes in that history, the first in 2008, reflecting the auction rate crisis that occurred at that time prior to the 2008 financial crisis, and again in March of last year related to COVID. You'll see recent history rates are extremely low, and as I said, the most recent reset was at 0.2. 0.02, sorry. Turning to the next page, we have the full history of bonds issued by the system, starting in with the 1993 series, running through our most recent issuance, 2020A. We have 3 bond series still outstanding. As we mentioned, 129 million in variable rate, 74 million from our 2013 A issuance, and 310 million from the 2020 bonds, which was a combination of refunding other previously issued debt, as well as roughly $100 million of new funding. We estimate that over the life of our bond program, refundings have saved us just under $145 million. Turning to the next page, we have the uses of that new money, planned uses of the new money in the 2020 series. It was spread, as you can see, across multiple facilities in our system, reflecting known needs at the time that the bonds were issued in consultation with Office of Facilities Development and Materials Management in their previous work in assessing the status of useful life issues and needs at the facilities. And on the side, we have a breakdown of some of the types of uses. It sort of collapses down to be roughly 25% for a variety of equipment purposes and 75% for a variety of infrastructure. There is some review ongoing of this list, the specific projects underlying this list. We're looking with materials management and with facilities development at possibly shifting some projects among our various sources. So we may have some projects that the anticipated funding with bonds that, based on the timing, are more appropriate for city capital. We may make some minor adjustments to this list as we go. Moving on, we have the status of the construction fund for those new projects from the 2020 bond issuance. Still very new. We have a balance of $97.57 million. We've done a small withdrawal of $2.4 million to date. As those projects proceed, and they are ramping up fairly quickly, we anticipate we will be drawing down these funds. We expect that the projects assigned to the bond fund will be completed within roughly 18 months. Moving on to the arbitrage report for our refunded bonds. The Internal Revenue Code requires that tax-exempt bonds do a arbitrage analysis to identify any interest income that must be rebated to the IRS. We are required to conduct that analysis every 5th year of a bond issuance or at the final maturity. Because our 2020 refunding fully refunded the 2008 Series A and 2010 Series A bonds, we conducted a arbitrage analysis using Hawkinsdale Fulton Wood, and they concluded that there was no arbitrage liability on either side. Moving on, we have two short-term bank loans that the system took out as a means of financing short-lived projects on a sort of more as-needed basis as opposed to issuing bonds. We have a secondary loan a secondary lien related to these loans on the lockbox that is a springing lien, so that it is not in effect, that would go into effect in the event that there was any default on payment. We have two loans, as I said, one with JP Morgan for $60 million. We have fully expended this loan. It was a fixed rate a drawdown period that converted to a fixed rate loan and at a rate of 2.088% and has a final maturity of July of next year. Moving on, the second loan is with Citibank. This loan, advance the slide, please. The second short-term loan that we have is with Citibank. There are two components to this loan, or two tranches, both $30 million. One being a fixed rate loan with an interest rate of 2.17% that will mature in November of 2022. and the second tranche of $30 million being a revolving loan with variable rate that most recently reset at 0.62% as of July 7th. This loan closed more recently than the prior loan. There is still a balance available to spin down. We have vouched to date 45 or just over $45 million of the $60 million and are working with materials management and OFD to ensure that we draw down the balance in a timely manner. That concludes the presentation. I'm happy to take any questions.
Okay, I'll go around and ask Matt, any questions?
No questions.
Any else?
I have a couple of questions. Thank you for your presentation. I'm sorry if my questions sound very basic. For the 2008 B and E, is there is a variable rate? I know that the maturity, I think you said that one is 2023?
2023 is the latest maturity. There's some variable variety in there. So there are two series that mature in 2026 and the others in 2035.
But my question in the case is, since the rates are so low, is it possible to compare this to a fix, or still it's more advantageous for the system to keep it variable?
I mean, it's a matter of debate. I think there's some benefit to having a portion of your portfolio in variable rate, which always tends to be lower absent, there's always interest rate risk, but there's also, the risk, the potential of the lower rate. So right now those rates are so low that it really, we chose to stick with the variable rate at the time that we did the refunding and not convert these. Even though rates are very good, it's something, we can periodically continue to review. I think, generally there's the advice that we've typically gotten is to sort of look for some balance and maintain some portion of the portfolio as we're able to take advantage of low rates.
Oh, okay. And then the other question that I had was in the slide 4 for all the bond use, they all went to a specific hospital. There is no anything allocated to central, to the headquarters.
Not for these particular projects. I think we asked both materials management, excuse me, supply chain, and Office of Facilities Development to sort of look at known outstanding projects to pick things that were priority that could be completed within that 18-month time frame, and also that would we needed to achieve a certain useful life of the assets that would be produced through the projects because of the refunding aspect of the transaction. So we needed to sort of match to some degree the useful life based on what we refunded. So they sort of took all those parameters and looked through their lists of projects and kind of came back to us with this that estimate those.
And none of them went to the central, all of them were to individual facilities.
Correct.
And the third question, sorry about it. When we're talking about the bonds, and there are that we don't seem to have used everything that we bond. Is that correct, or am I getting? I'm reading this.
In terms of having available funds.
Yeah. So we use all the money that we got from the bond has been allocated and has been used.
It's been allocated but not used, yes.
And during the time that has been allocated but not used, we are still paying the bonds proceeds to the bondholders.
Mm-hmm.
So we are paying, and that money is no work. It's not invested anywhere else to gain any interest.
It is invested, but interest earnings are very low, and that starts to get into that arbitrage analysis. So we, if we were to earn interest above our own interest costs, because these are tax exempt bonds, that would ultimately be due back to the IRS.
Yeah, I did understand that. So, but are we trying to at least reduce the cost of the unused money? Again, we already took the money from the bond holders. We have a seating, so more or less it's not working.
Yeah.
Is there anywhere you show the interest of what we're earning on that unused money and how it compares to what we're paying the bond holders? And
we can show that in a future report. It's not interest rates are not great, and we are restricted in what we're able to invest in. We need mostly government, documents or securities, because treasuries, because we need to be in very low risk investments. So it'd be very difficult to sort of make any significant.
so kind of maximize that.
And I think, Linda, that's why the projects that you selected are priority projects that you expect to spend the money relatively quickly, right? You mentioned 18 months. Is that 18 months for completion of the project or 18 months to spend the money? Do you think?
We would like it to be 18 months to spend the money.
Right.
And there's a range in there. So the equipment projects can happen quickly, much quicker than some of the infrastructure. But even the infrastructure has a range. I would say from there's a handful maybe that are 9-month projects. Both of them are probably 12 to 18 months.
Right. Because to Fanny's point, the money sitting around, not going to work, but we're paying interest on the bonds. And because of the relationships in the interest rate market, we can't earn very much. So there's some negative carry there.
And that's what I'm trying to understand. But like, for example, if we look, and I'm sorry, thank you so much, Sam, but if we look at the one issue in 2008, we're talking about around close to 13 years now. And it says that it's outstanding 129 million. And the final maturity is 2031.
So this is a different concept. So here, this is the remaining debt that we owe to pay back. Those funds have been fully used. So in our bond fund now, it's only the money from 2020 that we just recently borrowed.
Oh, okay. So in that case, all the from 2008 has already been spent in facilities.
Yes.
Okay, that's what I was not clearly. Thank you.
Sure.
Madam Chair.
Bob, do you have questions?
No questions.
Sally?
Just a couple of questions. So these are specific projects, not generic allocations, 18-month spend and specific useful life. I'm just curious if were there a significant number of projects from which you could select? Was it a real challenge to identify projects that fit in that profile?
I would say yes, there was a significant number, and I'm speaking, at this point to some degree for Christine and her team,
Yes,
and the supply chain team who selected. But I know, from our work with them on capital budget, that there are substantial needs throughout the system that far exceed, this amount, that far exceed the amount available through our city capital budget and other sources as well. So we have identified hundreds of billions of dollars of projects, should we have access to more funds that we could.
okay, thank you. And you said that some projects, most of the projects will be funded, some might be shifted to capital because they can't meet your time frame. Okay. And the last loan, the JP Morgan Chase loan, is that just a loan?
It's a bank loan.
And is that, do you have anything securitizing that, or just a straight out loan?
The JP Morgan was securing
lien on the equipment.
Yeah, a lien on the equipment. That was primarily equipment, IT equipment.
And that's what the $60 million has been used for?
Yes.
And there was a secondary pledge of is that?
Yes, both that one has a secondary pledge on the lockboxes.
Okay, thank you.
Thank you. I actually did have one question that are the loans tax exempt, or are they?
Yes.
Oh, they are. So do you have similar arbitrage concerns on those? Because the Citibank loan, you still have 12 million that hasn't been spent, right?
We don't have to do arbitrage report on this.
But you don't.
We do.
Oh.
We do. But we don't have any liability.
You don't have any liability because you still haven't been earning as much as
The earning is very low.
even though you have a portion of it as a revolver, I mean, at a variable rate, which has been very low. Is that so?
The variable in the loan, there is a spread on top of the sigma
Right.
rate. So the rate is still higher than
What you can earn.
what you can earn. The spread is, I believe, is 60 basis point, 0.6%. So earnings in treasury is very low.
How far out do you invest that money?
I think cash management invested in a very short
Very
period.
short.
Yeah.
So why is it that there's still 12 million from the?
It's a mix of equipment and infrastructure, and I think, honestly, there was some pause in drawing down and focusing on those projects during the COVID period. And we've recently super engaged with both teams on looking at what is assigned to this balance. I think there's some projects that may be completed that need to close out, and there may be some amounts where the project came in under, and there's some funds that can be reassigned. So we're looking at that actively.
So the pause really was you were spending the money, even then kind of it hasn't been sitting there for 4 years or whatever without. Because I think if it has, I mean, we should look at maybe trying to reprogram that quickly and spending it somewhere else rather than having it sit there, or else pay down some of the loan, right? If there's ability to pay it down. Sure.
Can I have a follow-up?
Sure. Go ahead.
Your question. These are loans that when you take the money, you take it all at once and you start paying interest on the loan, or they are lines of credit that you only pay interest on the money that you use from that line of credit?
It varied. So they started with a drawdown period where we could draw as needed.
And you only pay interest in as much as you draw.
Right. But there was sort of a finite drawdown period, and we got to the end, and we wanted to take advantage of that capacity. So what was left at the end, we did draw down and put into a fund to spend from. And so that our intention with these loans was to have it be a more as-needed borrowing as opposed to the bonds. But we did sort of end up doing it in a little bit of a hybrid fashion.
But if we go into another loan, will we try to extend the drawdown so that we use it more as a line of credit? What are the disadvantages? Like higher interest?
Well, doing these bank loans is a higher interest cost than our bonds, but the expectation that was the advantage, that it gives the ability to draw down as needed.
And tended to fund shorter lived assets too, right? So the bonds are good. You can go longer lived assets.
Yeah. Thank you.
Sure. Any other questions? Oh, the only comment that, Fanny, I do think that it was a good question on the variable rate, because fixed rates are super low, but the variable rates are so low right now at 2 basis points. It's very attractive, I think, still and it helps to offset a little bit this negative earnings on construction funds and things like that. So there's a little bit of a.
I think, but I was thinking like they are so low that it's good to lock it now, because if the only way that they're going to go is up.
Right.
So, but if the idea is that you have to have a balance,
right,
I guess there are some benefit to avoid the arbitrage, perhaps.
Yeah. Okay, great. So let's see. There aren't any more questions.
You think Jose may help?
Oh, sorry, Jose. You are not allowed to vote, but you are allowed to ask questions. I'm sorry I didn't ask you. Do you have any questions?
I am listening, and I don't have any questions. Thank you.
Okay, thank you. So thank you for the presentation. Is there any old or new business to come before this board? If there's no further business, I declare this meeting adjourned. Thank you.
Great presentation, ladies. Thank you.
Very-
Thank you.
I called you yesterday, the day before.
and the phone was busy 4 times, and it stays an hour and a half. So the guy got my answer to someplace else. But, not a big deal. What had to do with this thing happened to South Brooklyn. And my thing, because I know Brooklyn, my wife's Brooklyn, and she's a dentist, a great dentist. So she's next to Vincent.
Yes.
And